All right, what's going on, everybody? Um, this one is one I've been telling a lot of friends, family about for quite a long time. Um, One of the things we hate the most about purchases is interest. And a lot of times we get frustrated about the interest rates that we receive. And typically, once you start to understand how interest and principal payments work, um, you no longer are too much concerned with interest rates. There's so many remedies to interest rates, such as refinancing, which involves getting a better credit score first, and then refinancing at a lower interest rate. But then there's another way that doesn't involve getting a better credit score, that doesn't involve getting a new loan or refinancing an existing loan. Doesn't resolve any of that. It's basically comes down to your discipline and basically, I guess, patience. So it's basically all in your hands. You can control it. I'm going to go over a couple ways, but before I do, I just wanted to say one of those ways, before we get into this, I'm going to get into this webinar, and it's just going to show you a lot of the terms that these are called, so you can use these terms when you're dealing with and negotiating with your servicers, because some servicers have different, how can you say, sometimes there's penalties for doing this process. It's not illegal, but it takes money out of their pocket, basically. It takes money out of their pocket, puts money back in your pocket. So you can literally take any payment, whether it's a credit card payment, it's an auto loan, mortgage, anything that incurs interest. Take that loan, divide it by 4, and you would pay a fourth of that loan every week, as interest accrues daily. So when you're only making your payment, your monthly payment one time, you've allowed the term of your billing cycle, whether it's 28 days, 23 days, whatever it is, of interest to accrue before making your payment. So less goes to principal, and then you have more is applied to interest. Interest is free and clear money that the servicer makes off of you. So if you like to have more money in your pocket and you have money in your budget weekly, pay it weekly as opposed to paying it monthly. The savings could turn out to thousands. It depends what type of interest rate you're talking about and what type of purchase. On a mortgage, you could reduce the payoff term by years. So you're saving yourself literally thousands, depending on the size of your purchase of that home, how much it cost you, and how much your interest rate is. Typically, interest rates are pretty low, sometimes between 7. If you can get in now, I think interest rates are probably like 3% or something like that, or 4. Um, so it's a really good time to refinance and think about the information I'm about to share with you. All right, so let's get into the terms. This is just an article that I found that supports everything that I was wanting to share with you. So we're going to go into it, and I even learned a new term in this, so it's pretty cool. So it's common knowledge that you are going to pay interest when borrowing money. It's going to happen. When it comes to home buying, you may not realize just how much interest you will be paying. Wow, like there's a number for you right there. So you're approved for a 300,000 30-year mortgage with a 4% interest rate, which 4% interest rate is pretty low, but not over the life of a 30-year mortgage. That can translate into thousands. So it's 4.41% APR. If you make your monthly payment as required, then you'll end up paying a total of $215,609 in interest over the life of that mortgage term. It's a lot of money. That's almost another house. You can purchase another property with that. So wouldn't you like to put this back in your own pocket? So exactly what I was thinking. That's almost as much as your loan principal. You could have paid your house off. So it may sound scary at first, but we have a secret. Did you know that there are ways to save money on mortgage interest? It's true. Read on to learn 5 of the most popular ways to accomplish greater long-term and overall savings. And remember, this can be applied to paying on cars, boats, furniture, appliances, whatever it is where you have an account where there's interest involved. So this one, as I just told you, I was telling you about making it 4 payments a month. This one is speaking about biweekly, and it's going to show you pretty much how much you're going to save in different things. So giving you the numbers, which gives you the incentive and the discipline to actually put this into play, whether you pull money from somewhere else, that if you don't have the money to make a fourth every week, maybe you can cut into your entertainment expense, maybe getting your nails done less, maybe twice a month, or whatever, if it's less, or skipping a couple lattes or something like that. You can come up with the extra money and you can make these payments weekly and add that money back into your pocket, back into your budget. So making a payment every 2 weeks adds one all principal payment to your mortgage each year. So it's a beautiful thing. Instead of taking 12 payments per year, the biweekly payment plan asks for one payment every 2 weeks, which adds up to 13 payments per year. The extra payment you make each year is applied to your principal, so your interest also decreases with each reduction in principal. Plus, the more principal you pay, the quicker you build equity in your house, which again translates to money that you can use. You can leverage the equity in your house to buy another property, to take a vacation, to finance maybe tuition for your children, or build an extra room in addition to the house, to buy a water heater, things of those natures. The conventional logic is that increasing the frequency of the payments doesn't allow interest to build up, and throughout a 30 or 15-year mortgage, that can equal years eliminated from your loan. Look at that, years. So you can already tell what type of money we're talking about, putting back into your pocket and back into your budget. Just be sure your mortgage servicer allows for you to make biweekly payments. Remember, we were discussing this when we first started. Sometimes you can do so at a penalty, or sometimes your servicer does not allow it. And for the reasons I explained, is because this is how they make their money, not so much off the principal, but their money free and clear is the interest that they make. So the more interest they can make off of you, the happier they are as a business. It's better for their bottom line and for their balance sheet. So it says, and it doesn't add fees to your statement for making them. Those fees can add up, resulting in little to no benefit for you. Also, along that same line, be sure to ask if your biweekly payment is applied upon receipt or if it is held until the end of the month, which defeats the purpose, or even the end of the year. So this is exactly what it's saying. The actual benefit of biweekly payments is when that amount is applied upon receipt. So these are questions you want to ask and discuss with your servicers prior to implementing these plans that I'm telling you about. So extra mortgage payments, because you can make principal only payments. This is something that is in addition to your actual mortgage payment that is due monthly. You cannot make a principal only payment and then ignore your obligation for your monthly mortgage payment. Otherwise, you will get in trouble, and you'll refer back to this video with comments saying, hey, I got in trouble. So it's in addition to, you can make it along with your monthly payment, but talk with your servicer and find out, or look on your servicer's website under frequently asked questions and see if you can find these answers there. And if not, you can chat, email, or call your servicer and get those answers. So, all right, the former option allows you to choose if and when you pay extra towards your mortgage loan. Say you receive a large tax refund or performance bonus from work. It may be worth putting some or most of it toward your loan principal. Like, I know you want to get it and probably party or buy some outfits or something that you had your eye on, or take a vacation. But if you realize well, not the ramifications, but the benefits of investing this into probably your largest asset, and this is your home, you can leverage the equity in your home for collateral and receive another loan and totally buy another property where you will not really repeat this process, but again, you can build up equity. You can rent this place out. You can do Airbnb. There's a couple other options that I can discuss that we can generate money from that property. That one I'll do by consultation. I'll discuss that with you. If you can email me at mylife, MYLIFE 180 at gmail.com. In the subject line, you want to put ways I can make money with my existing house. So put that in the subject line. I'll know what you're talking about. I'll usually respond within 24 hours, and I can discuss options in exchange for a consultation fee, where I'll be able to walk you through some things and let you know how just generating additional income from the property you have that does not involve renting out the property to anyone else. So again, it can be in addition to, if you wanted to rent that property or use it as an Airbnb property, it'll be in addition to that. So it's an extra revenue stream. So I think it'll be in your best interest to really reach out to me, and let's discuss some of those options. But I'm going to get back to this real quick. So it says, all right, this allows you to save significant money while taking years of interest payments off your loan, depending on how much you're able to spend. The second option of putting more money towards your monthly payment can also result in incredible savings. Let's consider this example. Say your original loan amount is $400,000. You've committed to a 30-year conventional loan at a 4% interest rate, 4.41 APR. Not considering escrow, your monthly payment usually is about $1,910. But if you can put an extra $100 towards your monthly amount, you may be looking at $29,801 in total savings. This would help you pay your loan off 2 years and 8 months faster, which would be beautiful. Or you can do this. I came across this in my mortgage loan certification class, but you have to pay off a certain amount of it. So we're going to read in and see what this says. Yeah, because it's already saying it right there. If you financed your home with a conventional mortgage, but you did not put down 20% of the purchase price, chances are you were hit with PMI. It may not have seemed like a big deal at the time, since it got you into your dream home for less money down. But now that you're a few years into your mortgage, that cost may be adding up. Here's the good news. You can ask your lender to cancel the insurance as soon as your mortgage balance falls below 80% of the home's appraised value. This can happen if your home's value has gone up or you have repaid some of the principal. It requires an appraisal to confirm your home value. But once that's done and has verified and you met the threshold, you can be PMI free. So you can put that money back in your pocket. So this is a new word that I just learned as I went through this article a little bit before I started this webinar. But recast your mortgage. Recasting, also known as reamortization, happens when you pay down a significant portion of your home loan and decide to recast your existing loan. You're altering the mortgage payoff process. This involves a new loan term length, but not a new loan or loan type as with the traditional mortgage refinance. Your monthly principal and interest are recalculated, so you end up with a lower monthly payment over the existing term of the loan. So you see the magic there? You don't have to fill out a new promissory note. You don't have to execute a new mortgage. You don't have to qualify credit-wise. This has nothing to do with getting a new inquiry, none of that stuff. It's typically what you already have, and it's just, this would be based off what it spoke about up here if the home value has increased, or if you have additional equity into the house. This is something that you can work out. So Streamline Finance. If you have a government-backed loan, you may want to look at Streamline Finance. A Streamline refinance allows you to take advantage of a lower interest rate and a lower monthly payment. Plus, there are lenders who will work with you to lower your rate without resetting the term. So your term will not move at all. If you're 12 years into your 30-year mortgage, you will still be 12 years into your 30-year mortgage. It will not extend it or move it out as a refinance of it. At American Financing, for example, there are custom loan options that can be written into 8, 14, 19-year terms, whatever is needed. So this would be the balance of your 30-year mortgage is what they're discussing. Because if you've been paying for 6 years, you should be able to refinance to a 24-year loan. It's simple. It's an easy way to save and it's customized for you. If you're in a conventional loan, you have a similar option called a rate and term mortgage refinance. So these are things you want to discuss with your servicer. So let me see. So you're able to change your monthly rate, your loan term, or both. And since you aren't cashing out, you're not taking equity out of the home, you're still leaving it in there. So you will likely receive a lower, more competitive interest rate. And as mentioned above, when working with American Financing, you'll be provided with custom loan options that don't reset your loan term. It's your term, your way. So key takeaways, remember, you're charged interest based on your outstanding principal. The sooner you can pay down your principal, the less interest you'll be charged. It's just that simple. So keep that in mind. And like I said, I know a lot of us, we rather have money in hand and we want to have that money for instant gratification. We want to party, we want to go on vacations, we want to do all these things, but not thinking of how that money that you're spending on those, if you reallocate it, that money, you're actually putting yourself in a better position where you could, like I said, you can leverage that. One property turns into two properties turns into four. It's just that simple. It's just about just having the discipline and having the vision is all you need. Thanks for watching.